Tesla delivered 480,126 electric vehicles in the second quarter of 2026, a 25% year-over-year increase that crushed analyst expectations. Wall Street had predicted around 406,600 deliveries. The market seemed primed to celebrate. Stock futures jumped. Financial media ran headlines about recovery, momentum, and Tesla reclaiming its growth narrative. And then something strange happened. Tesla shares fell 7.49% on the announcement day, posting their worst day in nearly a year. The disconnect between the headline numbers and the actual market reaction reveals something critical about what's really happening in the electric vehicle industry right now. The story isn't about Tesla's strength. It's about Tesla's disappearing dominance in a market that's fundamentally reshaping itself, while investors fixate on quarterly delivery figures. Start with the math. In 2022, Tesla controlled 75% of the American electric vehicle market. That was dominance. That was monopoly adjacent. Every EV sold in the United States had a 3 in 4 chance of being a Tesla. 4 years later, that number has collapsed to 45%. The math is brutal. Tesla lost 30 percentage points of market share in 4 years. That's not a gradual decline, that's a market inversion. General Motors is now firmly in second place with 56,679 units sold so far in 2026, down 32.6% from the previous year. Ford is pulling back on electric vehicles entirely. Hyundai Motor Group is experiencing headwinds. Meanwhile, every other automaker, from Volkswagen to BMW to Stellantis to Volvo, is racing to expand their EV lineups. Around 150 new electric vehicle models have been announced for release in 2026 alone, followed by approximately 70 more models in 2027 and 40 in 2028. The pipeline of new electric vehicles has never been longer, yet Tesla's lineup has never been smaller. The company still relies on the Model 3 and Model Y for roughly 95% of its deliveries, but here's the truly staggering number that deserves more attention than it gets. The broader United States EV market declined 22% in Q2 2026, while Tesla grew 25%. That sounds contradictory until you understand what it actually means. Tesla is winning a larger slice of a rapidly shrinking pie. Americans are not abandoning the idea of electrified vehicles. They're just not choosing pure battery electric vehicles anymore. They're choosing hybrids, plug-in hybrids, conventional hybrids. The combined sales of hybrid vehicles, plug-in hybrids, and battery electric vehicles in the United States rose to 16.3% of total new light-duty vehicle sales in 2023. By 2026, industry analysts project that electrified powertrains will account for an even larger share of the market, but that growth is coming almost entirely from hybrid technology, not pure EVs. The hybrid segment is the one that's actually expanding. The EV segment is the one struggling. Tesla's problem is that it has bet its entire future on a category that American consumers have decided to abandon, at least for now. This brings us to the announcement that was supposed to change everything. On June 29, 2026, Tesla Vice President of Vehicle Engineering, Lars Morvey, appeared on a podcast and dropped a teaser. He said that on July 7th, there would be cool news about things happening around Giga Texas as part of the scaling effort. The internet erupted. Investors speculated wildly about what this could mean. Would it be news about the Cybercab production ramp? Would Elon Musk announce a massive expansion of the Giga Texas facility? Would Tesla reveal timelines for the next generation Roadster production? Would the company announce that it had solved the autonomous vehicle problem and was ready to deploy a massive robotaxi fleet? The Giga Texas facility spans over 10 million square feet. It already produces the Model Y in multiple trims, manufactures the Cybertruck, hosts a massive Dojo supercomputer cluster, runs on-site 46's 80 battery cell production, and has a dedicated Optimus humanoid robot factory under construction. Tesla filed site plans with Travis County in March 2026, outlining a significant expansion, including a new Terafab North campus, a 2 million square foot facility dedicated to next-generation AI chip research and production, and an additional 5.2 million square feet of new construction across multiple phases. That's the context. That's what people were expecting to hear about on July 7th. On July 6th, the day before the announcement, Tesla posted on social media that it had officially launched its driverless robotaxi service in Miami, Florida. This was the third state outside Texas and California where the service would operate. The stock jumped 6%. Investors were positioning themselves. Analysts were updating their models. The narrative was building. The big reveal was coming tomorrow. And then July 7th arrived, and Tesla released its 2025 impact report. That was the announcement. Not Cybercab scaling, not Giga Texas expansion, not a robotaxi deployment timeline. An environmental impact report framing the company's mission around amazing abundance. The internet immediately noticed. One prominent Tesla observer posted on social media that Moravi had teased a major announcement, but the news turned out to be the release of the impact report. Many had expected announcements about Cybercab, Robotaxi, full self-driving, or Optimus. Instead, Tesla published sustainability metrics. The disappointment was real. But if you look past the disappointment and examine what the impact report actually revealed, a much more interesting story emerges. Tesla customers collectively kept 37 million metric tons of carbon dioxide equivalent out of the atmosphere in 2025 alone. To put that in perspective, that's roughly equivalent to the annual energy consumption of nearly 5 million homes. That's a meaningful number. But it's not the number that tells you where Tesla's business is actually heading. The real number is in the energy deployment section. Tesla's energy business deployed 13.5 gigawatt hours of battery energy storage during Q2 2026, compared to 9.6 gigawatt hours in the same quarter of 2025. That's a 41% increase year over year. For the full year, analysts expect 57.9 gigawatt hours of energy storage deployments in 2026, climbing to 79.8 gigawatt hours in 2027 and 150.1 gigawatt hours by 2030. The energy business is now growing faster than the automotive business. It's also more profitable per unit. It's also facing fewer competitive headwinds. It's also generating recurring revenue streams. While everyone was watching Cybercab development and Robotaxi expansion, Tesla's real growth engine was quietly becoming something else entirely. Megapack deployment, battery storage, grid optimization, solar integration. These are the products that are actually scaling. These are the products that are actually profitable. These are the products that don't require solving the autonomous driving problem first. Now return to the core question. What is Tesla's actual announcement? If the impact report wasn't really the announcement, and if the Giga Texas scaling efforts remain officially unannounced, then what news was Moravi actually hinting at? The answer might be embedded in the data itself. Tesla is transitioning from a growth story to an operational efficiency story. The company that once promised to transform transportation is now focused on transforming energy infrastructure. That's not a smaller story, it's just a different story. And it's a story that doesn't require Tesla to beat Waymo in the Robotaxi race or solve full autonomy in the next 12 months. It just requires Tesla to keep deploying megapacks and solar installations faster than the competition can match. Let's talk about the competition, because that's the real reason Tesla's dominance is disappearing. In China, BYD surpassed Tesla as the largest EV maker globally on January 2, 2026. That single data point is more important than most headlines recognize. It reframes Tesla from category king to contested leader. The game changed. BYD has a broader lineup of electric vehicles and plug-in hybrids. It benefits from strong domestic sales in China, the world's largest and fastest growing EV market. It's expanding aggressively outside China. BYD's May EV deliveries in 2026 reached 383,453 units. Tesla delivered 480,126 units in the entire second quarter. Do the math. That means BYD is on pace to deliver over 1.5 million electric and plug-in hybrid vehicles in 2026 alone. Tesla is tracking toward 1.6 million to 1.7 million deliveries for the full year. The gap is closing. More importantly, BYD's product portfolio includes a range of price points, battery options, and powertrain configurations that appeal to different customer segments. Tesla's portfolio is essentially three models: the Model 3, the Model Y, and the Cybertruck. The Cybertruck is a niche product that contributes very little to Tesla's bottom line, according to industry analysts. The Model 3 and Model Y still generate nearly all of Tesla's revenues. Beyond BYD, the competitive landscape has fundamentally shifted in ways that most Western analysts still don't fully appreciate. Geely-owned Zeekr's May and EV sales in 2026 were up 81.8% year over year. Sherry Group's May NEV sales reached 300 units, up 58.8% year over year. Leapmotor's June EV deliveries jumped 95% year over year to 93,376 units. Saiki May EV sales reached 182,000 units, up 46.5% year over year. These are not household names in Western markets. Most Americans have never heard of Zeekr or Chery or Leapmotor, but they're scaling production volumes that would have been unthinkable 5 years ago. They're doing it with lower price points. They're doing it with competitive technology. They're doing it with software that rivals Tesla's in many respects. They're doing it without the baggage of a CEO embroiled in political controversy. They're doing it with government support in some cases. They're doing it by learning from Tesla's mistakes and building manufacturing processes that are even more efficient than Tesla's unboxed manufacturing concept. This is not a minor threat. This is the reshaping of global automotive manufacturing. Remember that Tesla experienced consumer backlash during 2025. due to Elon Musk's public political involvement, his endorsements of anti-immigrant extremists in Europe, and his work with the Trump administration to shrink the federal workforce. That's not speculation. That's directly cited as a factor in Tesla's weaker sales performance last year. Some prospective EV buyers chose competitors specifically because of Musk's behavior. That's a unique problem that most other automakers don't face. Their CEOs are not generating this kind of consumer blowback. In Europe, the story is slightly different, but ultimately convergent. Tesla has lost significant market share in Europe to domestic producers. Polestar is leaving the market entirely. Volkswagen and Volvo have canceled certain EV models, but both companies are also rolling out new EVs. BMW, Ford, and Stellantis have new electric vehicles on the way. The global electric vehicle model availability in 2025 stood at 630 distinct models. Sales, however, remained highly concentrated across a small group of bestsellers. Just 5 models accounted for about 20% of global battery electric car sales. The Tesla Model Y made up nearly 8% of total battery electric car sales globally. The Tesla Model 3 accounted for 3.6%. Every other EV model was smaller, but that concentration is misleading. It suggests dominance. What it actually represents is the beginning of diversification. As EV adoption grows, automakers tend to offer a greater range of electric car models, which leads to a diversification of consumer choice. More choice means less dominance for any single manufacturer. That's basic market dynamics. The pricing environment has changed as well. Following the end of federal EV tax credits in October 2025, Tesla rolled out lower-priced standard trims of the Model Y and Model 3, contributing to modest progress in price competitiveness. A number of other car makers followed suit and slashed the prices of their existing electric models. In 2025, there were nearly 20 models with entry-level prices below $40,000, compared to fewer than 15 the year before. In 2025, the price premium paid for a battery electric SUV stood under 25%, a nearly 5 percentage point decrease from the previous year. As a result, more than 30% of battery electric SUV sales undercut the average internal combustion engine SUV in 2025, up from 20% the year before and less than 10% in 2021. What this means is that the artificial price advantage Tesla maintained through scale has eroded. Other manufacturers are closing the gap. The Model 3 base price starts below the average price of a new car in the United States at $36,990, but so do vehicles from Hyundai, Kia, Volkswagen, and increasingly Chinese manufacturers. The magic of Tesla's cost structure is real, but it's no longer unique. Now let's address the elephant in the room that nobody wants to talk about, the Cybercab situation. Tesla teased this vehicle for years. Elon Musk promised that Cybercab production would begin in 2026 and that the vehicle would cost less than $30,000. Cybercab is purpose-built for autonomous robotaxi operations. It has no steering wheel. It has no pedals. It requires full autonomy to function. It entered mass production at Giga Texas in April 2026, roughly on schedule. The assembly lines have been ramping up since then. Hundreds of Cybercabs have been spotted, staging and massing at Giga Texas, according to reports. First responder interaction plans have been added to official channels. The vehicle is being prepared for unsupervised robotaxi operations. But here's the critical problem. The Cybercab cannot legally operate as an unsupervised autonomous vehicle in most jurisdictions yet. Regulators are not moving at the pace that Tesla needs. Waymo is operating limited robotaxi services in specific markets because Waymo has been transparent with regulators, worked through the approval process methodically, and earned permission market by market. Tesla's approach has been more aggressive and less collaborative. The result is that Tesla's robotaxi fleet cannot deploy at scale yet, regardless of how many Cybercabs roll off the production line at Giga Texas. This regulatory reality is crucial because it exposes a fundamental mismatch in Tesla's business narrative that hasn't been adequately discussed in financial media. The company wants the valuation logic of a software and AI company while carrying the operating burden of a manufacturer. Software companies scale without friction. They don't require regulatory approval to expand into new markets. They don't have to worry about civil liability when their products fail. They don't face the scrutiny of federal safety agencies or congressional oversight. Tesla is trying to be both at once. It wants to be valued like NVIDIA or OpenAI because of its AI capabilities and software potential. But it's structured like Ford or General Motors because it builds physical vehicles that operate in public space under safety law, media attention, constant regulatory scrutiny, and civil liability. That tension sits at the center of Tesla's current challenges. Every quarter, Tesla promises that full autonomy is coming. Every quarter, regulators move slower than Tesla's timelines would suggest. Every quarter, the gap between promise and reality grows wider. That gap is not temporary, it's structural. The company has invested billions into autonomous driving and AI infrastructure. It has built massive Dojo supercomputer clusters. It has collected billions of miles of real-world driving data. It has trained neural networks to interpret that data. None of it matters if regulators don't approve unsupervised robotaxi operations. And regulators are moving slowly, much more slowly than Musk's timelines would suggest. Full self-driving supervised, Tesla's more limited autonomous offering, has expanded significantly in 2025 and 2026. The company expanded access to Australia, China, New Zealand, and South Korea in 2025, with Belgium, Denmark, Estonia, Lithuania, and the Netherlands following into 2026. The rollout pace tracks with what regulators have been saying on the ground. Norway has already laid out its next steps following the Netherlands RDW approval. The safety data is compelling. But here's the catch. Full self-driving supervised is not the same as full autonomy. It still requires driver supervision. It's enhanced driver assistance, not autonomous robotaxi technology. Tesla has sampled 65 million miles of real-world driving in 2025 and found that FSD-engaged trips used 5% less energy than the same distance driven manually, with the efficiency gain peaking in the 25-55 mph range, typical of city and suburban driving. That's a meaningful optimization, but it's not the robotaxi revolution. It's not the product that justifies Tesla's current valuation multiples. It's just a better version of what Audi and Mercedes and BMW already offer. The Cybercab, by contrast, is supposed to be different. With full autonomy and maximized ride-hailing, Tesla projects that Cybercab will avoid nearly twice the greenhouse gas emissions per mile of a Model 3 or Model Y. That's a compelling environmental narrative, but it doesn't matter if the vehicles can't be deployed. It doesn't matter if they're stacked up at Giga Texas waiting for regulatory approval. The manufacturing scaling that Lars Morvey was probably hinting at is real. The production capability is there. The infrastructure is there. The supply chains are there. But the regulatory framework isn't there yet. And that's the constraint that nobody wants to discuss publicly. Let's zoom out and look at the broader market context. The global EV passenger vehicle fleet is forecast to grow from under 100 million in 2026 to approximately 1 billion by 2050. That's exponential growth. It's the defining story of transportation infrastructure over the next 2 decades. But in the medium term, growth is uneven and increasingly unpredictable. Global EV sales increased by 25% in 2024 to 17.8 million units, with projected 23.7 million sales in 2025, and growth continuing through 2026. The market share of EVs in the light vehicle market reached 19.9% in 2024, and is expected to hit 25.5% in 2025 and 27.5% in 2026. Those are solid growth numbers, but they obscure regional disparities and the category fragmentation happening beneath the surface. China is projected to account for 61% of the total EV installed base in 2026. China is growing aggressively. Europe is growing through regulatory mandate. The United Kingdom just saw EV sales overtake petrol car sales for the first time, which is a meaningful milestone. But the United States is stagnating because consumers are choosing hybrids. Consumers are making a rational economic decision. That's the story that matters most because it directly impacts Tesla's market opportunity. In the United States specifically, car buyers have pulled back from fully electric vehicles and are embracing hybrids, according to Dan Hirsch, managing director at Alex Partners. The reason is straightforward. Americans have a huge country and people live far away from each other compared to Europe, where charging infrastructure is better and people don't have to drive quite as far. A hybrid vehicle gives American consumers the best of both worlds. Electric capability for short daily commutes and gas backup for long road trips, without the range anxiety or charging infrastructure anxiety that comes with pure EVs. The decision to buy a hybrid is rational given current infrastructure. Tesla's entire business model is predicated on consumers abandoning that rational choice and embracing pure electric vehicles. But the market is saying no. The market is choosing differently. And that's not a temporary phenomenon. That's a structural shift. Oil prices have also played a role. Trump's war with Iran drove up gasoline prices in early 2026, which temporarily boosted EV sales in Europe. But as a fragile truce between the United States and Iran took hold and diplomatic efforts began to stabilize the region, oil prices returned to pre-conflict levels. The temporary boost to EV sales faded. Gasoline became cheaper again. The incentive to buy an EV diminished. This is another constraint on Tesla's growth that's largely external to the company's control. Cheaper gas means weaker EV demand. That's just how market dynamics work. And unless there's another geopolitical supply disruption, oil prices are likely to remain relatively stable going forward. Let's return to the fundamental disconnect that started this analysis. Tesla beat delivery expectations by a significant margin, but the stock fell sharply anyway. Analysts were expecting 406,600 deliveries. Tesla delivered 480,126. That's a 73,926 unit beat. It's an 18% outperformance. It's the kind of earnings surprise that should send stocks higher. And yet the market punished the stock by nearly 7.5%. Why? Because the market has already accepted that Tesla's growth days are largely behind it. The company has already baked in the recovery from 2025's challenges. Institutional investors have already priced in the near-term bounce. What they're looking at now is the long-term trajectory, and that trajectory is not encouraging. The consensus for 2026 full-year deliveries sits at 1,958 units, according to analyst consensus, with a median estimate of 1,667,842. That's barely 1% growth from 2025 levels. Tesla once delivered 1.81 million vehicles in 2023. The company peaked. Now it's essentially flatlining in a category where growth is supposed to be explosive. Any beat on quarterly deliveries is welcome, but it doesn't change the fundamental trajectory. The company is no longer a growth story. It's a mature company managing relative decline in a category where it used to have absolute dominance. The market sees that. The market prices for that reality. That's why the stock fell despite the beat. The consensus is calling for Tesla to sell more than 3 million vehicles globally by 2029, up from the 1.6 million projected for 2026. That's 4-year growth, but it's not dramatic growth given the company's historical trajectory and given the acceleration of competition. 2 months before Q2 2026 results, Tesla said it expected to sell more than 3 million vehicles in 2029. But the analyst consensus, published after those statements, came in at 2.3 million in 2029 and 2.6 million in 2030. The company's own guidance was revised downward by analysts within weeks. That's not confidence. That's skepticism dressed up in professional analyst language. The energy business is the one genuine bright spot in Tesla's portfolio right now. Energy storage deployment is growing significantly faster than automotive deliveries. The margins are higher per unit deployed. The regulatory environment is more favorable overall. The path to profitability is clearer and less dependent on speculative technologies. Megapack units are generating recurring revenue through energy trading and optimization services. Tesla deployed 13.5 gigawatt hours of storage capacity in Q2 2026 and is tracking toward nearly 150 gigawatt hours annually by 2030. That's exponential growth in the right direction. SpaceX, which owns xAI, bought $269 million worth of Tesla Megapacks in April 2026, according to SpaceX's IPO filing. SpaceX is using these Megapacks to reduce xAI's electricity costs at its power-hungry data centers in and around Memphis, Tennessee. That's vertical integration of the most interesting kind. Tesla's energy products are serving other Musk companies, which creates revenue but also ties the ecosystem together in ways that competitors cannot replicate. Related party transactions like this actually strengthen Tesla's market position in energy storage because they guarantee demand and demonstrate scale advantages. More importantly, the energy business requires no regulatory approval for unsupervised operations. There's no liability question about whether a megapack can drive itself or function autonomously. The product either delivers the kilowatt hours efficiently or it doesn't. And the ones Tesla is deploying are working extraordinarily well. So what's the actual announcement? If it's not Cybercab scaling and it's not Giga Texas expansion, then maybe it's subtler. Maybe the announcement is that Tesla is officially transitioning from being a pure EV automaker to being an energy company that happens to make vehicles. The 2025 Impact Report emphasizes sustainability metrics, carbon reduction, and grid optimization. The company's capital expenditure plans show that Tesla is planning to spend more than $25 billion in capital expenditures during 2026, nearly triple last year's investment. That money is going into AI, computing infrastructure, battery production, and manufacturing capacity for several future products. But the allocation suggests that energy storage is getting a meaningful piece of that capital. The company is betting on energy, not just on vehicles. This reframing also explains why Morvi might have teased an announcement about scaling at Giga Texas, while ultimately announcing an environmental impact report. The scaling efforts are real. The manufacturing capability is there, but the real news is strategic. Tesla's future is in energy infrastructure and AI optimization, not primarily in vehicle production. The vehicles are still important. They're still generating revenue, but they're no longer the core of Tesla's growth narrative. The energy business is, the AI business is, the ability to collect data, train neural networks, and optimize complex systems is, That's a much more valuable long-term story if you're an investor who cares about durable competitive advantages and recurring revenue streams. But from a consumer perspective and from an EV market perspective, Tesla's disappearing dominance is the more important story to understand. The company that once seemed destined to transform global transportation has been decisively challenged by competitors who arrived later but learned from Tesla's mistakes and executed better in many cases. BYD is making cheaper vehicles with better technology and less baggage. Chinese manufacturers are scaling production at rates that would have seemed impossible 5 years ago. Legacy automakers are finally taking electric vehicles seriously and are leveraging their existing manufacturing expertise, dealer networks, and supply chain relationships to compete effectively. American consumers are choosing hybrids because that makes rational sense given current charging infrastructure constraints and long-distance driving patterns. European consumers are buying from Tesla's competitors because they've earned regulatory approval and because they've proven that they can deliver comparable technology at competitive prices. Global consumers are no longer viewing Tesla as the only viable option. The company is being treated as one competitor among many, and in many markets, not even the best one anymore. This market transition explains the seemingly contradictory response to Tesla's Q2 delivery beat. The numbers looked strong on the surface, but they masked an underlying deterioration in competitive position and market opportunity. Tesla is still the market leader in most regions worldwide at this moment. Tesla still has the best brand recognition among global consumers today. Tesla still operates the most robust charging infrastructure through the supercharger network. Tesla still has advantages in software distribution through over-the-air updates and continuous neural network training. But dominance is categorically different from leadership. Leadership is having the best products and the strongest market position. Dominance is what Tesla had in 2022 when it controlled 75% of American EV sales. That level of market control has fundamentally evaporated. The market has moved on from Tesla's monopoly. Competition has arrived in force from China, Europe, and legacy automakers. The playing field is leveling dramatically, and the announcement that was supposed to change everything turned out to be an environmental impact report framing the company's future around energy abundance rather than vehicle dominance. That's not the narrative Tesla wanted to announce on July 7th, 2026. That's not the story Wall Street was expecting to hear, but it's the narrative the market seems to be accepting. Investors are repricing Tesla as an energy company with some automotive business rather than as a pure EV manufacturer. Understanding that shift from EV dominance to energy ambition is the key to understanding where Tesla is actually headed and why the market reacted skeptically to a beat on delivery numbers. The market sees through the headlines. The market understands the reality beneath the surface.